The Federal Reserve just cut interest rates, causing the stock market to rally. But looking at the fear and greed index, it is still showing signs of fear. How can the stock market rally while there's tremendous fear in the market?
Hold up. Wait a minute. Something ain't right.
What's causing this to happen? Is this a sign that something worse is to come?
Winter is coming.
What's good? Julian here, and yes, the markets just wrapped up a pivotal October. The Federal Reserve just made another rate cut. Tech earnings came in strong. But the key question for November is this: did the Federal Reserve just save the market or signal that the economy is in trouble? Let's find out. Now, if you like videos like this, I'm going to give you 5 seconds. Help me out by clicking subscribe and also commenting more so that I can produce more videos like this for you guys. 5, 4, 3, 2, 1. Without further ado, let's get back into the video. So to start, let's find out what's driving everything right now. The Federal Reserve. Just last week, at the end of October, the Federal Reserve cut interest rates by another 25 basis points. That's 2 cuts in a row this year. And this is what Jerome Powell said.
The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored.
Now, heading into December, there was an initial 92.8% chance that the Federal Reserve would cut interest rates again by another 25 to 50 basis points. But as of now, the probability has dropped to around 63%. So, what changed? Powell made it clear in his latest statement: the next rate cut in December is far from foregone conclusion. In plain and simple English, this means that the Federal Reserve isn't guaranteed to cut interest rates just yet. They are keeping their options open, watching how the next few weeks of data unfold. And you can see why. The data has been mixed, with the government shutdown still in place. On one hand, hiring is slowing, layoffs are creeping up, especially in the tech sectors hit by AI automations. Companies like Amazon, Microsoft, and Salesforce have been cutting tens of thousands of jobs to protect margins and streamline operations. At the same time, inflation pressures have started to ease now that the tariff-driven costs have cooled off. And this is what supports the case for more cuts. But Powell also warns us that the inflation risks haven't disappeared. There's still a wide split among Federal Reserve members about whether the economy really needs more stimulus. He even mentions that quantitative tightening, basically the Federal Reserve pulling money out of the system, might be close to ending. And here's what he said in his recent speech.
Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing.
So that's a subtle hint that if the economy weakens further, the Federal Reserve could pivot towards adding liquidity again. In other words, it's possible to return to quantitative easing just down the road. So heading into November, all eyes are on the next batch of data, especially the jobs, CPI, and PCE reports. Now, if the data shows that the economy is slowing down further, the Federal Reserve will likely keep cutting rates to support growth. But if inflation starts picking up again or the job market remains strong, they will probably pause in December instead. In other words, November's data could be the deciding factor for where markets head in 2026. Now, since the last rate cut, the S&P 500 has been rallying non-stop. In fact, if you watched my previous video, you will remember I mentioned specifically that my SPY target was 689. Roll the clip. Right now, what I'm predicting is for price to continue rallying all the way up to my prediction, which is 689, which is what I targeted for S&P 500 for the longest of time. And guess what? It hit that level almost perfectly before correcting. So if you caught that move, congratulations. That is why you always want to keep up with these updates. Now, here's something interesting. Even with the S&P 500 pushing higher and higher, the Fear and Greed Index still shows fear, sitting around 35 at the time of this recording. So what's going on here? Well, the Fear and Greed Index isn't just about price. It tracks 7 indicators, things like market momentum, stock strength, market breadth, volatility, the put-to-call ratio, safe haven demand, and junk bond appetite. So right now, most of the market strength is coming from a handful of large cap tech names, namely the Mag 7. In fact, the Mag 7 consists of roughly 30% of the entire S&P 500, and that's where the greed shows up. Many of the other indicators are still neutral or fearful, and there are a lot of smaller stocks which are lagging behind. This is why the sentiment still feels cold, even as prices are heating up. Investors don't fully trust this rally. As the CIO of Verdant's Capital Advisors said, we are holding a larger cash position and adding some hedge funds exposure to protect against the downside risk. And this is what we are seeing exactly right now. Higher prices, but also higher hedging activity and cautious positioning in the options market. Interestingly, this kind of divergence often happens right before a bigger move. It's the calm before the storm. When the market climbs while fear stays high, this also means that there is a lot of cash waiting on the sidelines. I call this the FOMO wave. Once investors realize that the market isn't crashing and they have missed out on gains, they will rush back in, and this is where we see the explosive push higher before the next big correction. Of course, there's also another scenario too, a short-term pullback. The market might take a breather, shake out the late buyers, and continue higher again. This is where fear lingers while price rise, and volatility will tend to stick around. But as long as fundamentals and liquidity stay supportive, those dips usually get bought up quickly. The real question is, why does the S&P 500 keep pushing higher and higher? As mentioned earlier, it all comes back down to the data. If the next few reports show the economy slowing down further, there is still room for the market to climb, at least until the Federal Reserve's next meeting in December. Now, before I reveal my next S&P 500 target, do you want to know how I managed to make these predictions? So far, they have been spot on. And no, you don't need any prayers to get these numbers. If you want me to break it down step by step, comment "teach me" down below in the comment section. And if I get at least, let's make it a crazy number, 250 comments, I will make a video explaining how I do it. Now looking at SPY, I see that if price were to correct down, it will come back down to this level of support here before pushing up higher. But if SPY continues pushing up further, this is my next target for SPY. And you want to take notes? It's going to be 704. Don't say I didn't tell you. Now let's shift gears a bit. The recent rally isn't just about the Federal Reserve and rate cuts. It's also about getting a real boost from strong earnings from major players. Here are a couple of standout results from last week. Amazon having a massive rally, spiking up 12% after their incredible earnings report. It's their cloud division, the Amazon Web Service or AWS, which has increased by 20% to $33 billion. The fastest growth in years. And here's what I see for Amazon. Amazon breaking through its all-time high, I would say that it has a huge chance of going up even higher. Now, if you want to know what my next target for Amazon is, it is going to be $287. So there you go. This is another of my prediction that if Amazon goes higher, I expect it to go all the way up right over here, barring any corrections that they're going to have. Google also rallied about 6% after earnings, after its parent company Alphabet beat forecasts with a first ever $100 billion quarter. And here's what I see for Google. Currently, Google is also spiking up really hard and almost hitting my target of $294. And in fact, I see that it is already very close and would most likely hit somewhere between the week to come. Right now, since Google is going higher, I expect it to continue its rally up, and we shall see once it hits my price, what will the next price be. Nvidia also had a surge, making it the world's first company to cross the $5 trillion mark after it announced very large strategic deals and partnerships with companies like Uber, Palantir, CrowdStrike, Samsung, Nokia, to name a few. And with that said, here's what I see for Nvidia. Nvidia also coming very close to my target, which is 215, something that I've been talking about for a long time. And right now, if it does pull back a little bit, I expect it to come down to this level of resistance right here. Resistance breakout becomes a support before continuing its way up higher. Now, if it does go up, I do expect price to reach to this area, just like all my other predictions have come to pass. However, if Nvidia does not manage to do so, it will actually come down to this next level of support. However, not all big names soared. Microsoft, even though they reported strong numbers with its quarterly sales growing 18% to $77.7 billion, but its stock still slipped by roughly 3.6% anyway, as the company battled an outage affecting its Azure cloud computing platforms just hours before it disclosed its earnings. And after failing to cross this resistance right here, it has now fallen below this resistance and is now heading to the next support right here. And when it comes down to this support, I do expect that it will continue to play sideways until a breakout happens, either above this resistance, or if it breaks downwards, it will continue its way down. Meta also had its shares drop by 9% despite beating earnings, as it reported a $15.93 billion one-time tax charge. And from what I'm seeing, Meta is headed to this level of support right here. And in order for it to go up, it has to bounce off this level of support back to this level of resistance before climbing its way up again. Now, it does have many resistance to break through before it comes back to its original price right here. But knowing Meta, I believe that if the company continues to do better fundamentally, there is a huge chance that it will actually hit right back up. So if you're looking for a discount for Meta, I would say now is one of the best chances for you to actually grab a hold of some Meta. Although personally, I don't hold any Meta stocks right just yet. Apple also reported great earnings too, with its net sales increasing by 8% year over year to $102.47 billion, but fell short of analysts' expectations on the iPhone sales and revenue out of China, which was why Apple's shares didn't actually move much. Let's take a look at Apple. Apple is about to reach my target of $282. However, right now, if it does pull back, I do expect it to come down to this level of support right here before bouncing back up to try to attempt to reach to my target level of 282. I also want to take a look at gold right now. Gold has actually broken through this level of support right here, closing below. And from what I see, gold is actually now creating lower highs and lower lows, and I presume that it will likely be going down. Right here, if it wants to go up, changing market structure, it has to break above this level of resistance right here, which would mean that it would be likely that it's heading up. But if it still respects this level of resistance, there is still possibility that gold has a high chance of going down. Now, if you want to see how did I know that gold was going to go down, I'm just going to put the link of this video right about here so that you can actually go and check out. I mentioned this a couple of weeks back, but the data is still relevant, so do watch that. So right now, my main bias for gold would be to sell. I'm just looking for sells in different ways possible because it seems like it's still heading down. So with that said, that's all for this week's market breakdown. And if you found this video to be helpful, make sure to hit that like button so that more traders can see it. Subscribe if you haven't already. I drop new market updates just like this one here and trading insights every week. Also, one more thing, if there's a company that you want me to analyze, just comment below with the ticker symbol. I will be picking one from the comments, looking through it from the technical perspective level, just as what I've done right now. And if you want to see how I managed to catch a 180 pip sell from gold, as you know, gold is dipping, just click the link around this video and I look forward to seeing you in my next video. Bye bye.